What's up, traders and real estate investors? In this video, I'm going to share my research for my strategy for purchasing my next investment property. In addition to trading all the instruments that move, I also invest in real estate, specifically rentals. And I wanted to answer the question for myself, when do I think is going to be a good time to buy? This is going to be my own analysis, and this is what I'm going to be looking for. This is not going to be a prediction of the future. What I needed to do was come up with a strategy for myself so that I could be disciplined about what the US housing market was doing and when that would be a good time to buy. And it's going to be based around inflation as well as the broad US market based upon the Case-Shiller Home Price Index, which we're looking at on TradingView right now. Let me take off all my little icons, my cute little icons, and you can pull up the Case-Shiller Index on TradingView with the symbol USCSHPI. Now, what I've done is gone back because the chart on TradingView only goes back to 2000. We can pull up the full Case-Shiller Home Price Index here on the Fed's website, and it has data going back to 1987. So what I did was I put that into TradingView with a little line so I could get a little back data. And a few things kind of stand out. Of course, we have the housing bubble around 2006 where it topped out, and it took us almost 12 years to get back to the high. About March of 2018, the home price index reached that high. And since 2020, we all know what happened there. The money printer got turned on and housing prices have shot up. But is this out of the ordinary? Does this mean that we're in a bubble? I want to try to answer that for myself to know when would be a good time to buy, because we have started to see in the last few months as mortgage rates have shot up. That means the monthly payments that people can afford have gotten much higher. And now we're starting to see prices come back down. But where will they revert? Let me show you another chart that was very important in my analysis. So this chart is I'm going to copy this on a trading view right here. This is if you take the Case-Shiller Index of home prices and compare it to CPI, which is inflation, the Consumer Price Index. This chart goes back to 1970, about the time that the US went off the gold standard. And we start to notice a pattern in housing prices versus inflation. You call this pattern sinusoidal. In other words, it goes up and it goes down. And so if we just draw a middle line in here from the start to the end, we can see that price tends to revert to a mean and go in cycles when housing prices are compared to inflation. It goes above the mean, below it, above the mean, below it. And a couple other things you can see from this: the amplitude of this inversion has gotten wider and wider over time. Housing bubble, of course, shot it up way beyond that mean, and then the housing crash took it below the mean. Another thing about this chart: whenever one of these inversions starts, it tends to complete either from the top to the bottom. It's very smooth top to bottom as time goes along. So, another question I wanted to answer for myself was, what is the normal rate of appreciation that we can expect in the housing market compared to inflation? So I put together the data myself in a spreadsheet, and I looked at different time periods for home price inflation versus average total inflation. And so we'll start here on the left. Since 1971, the average home price inflation, that's 1971 to the present, 2023, is 5.45% year over year. So if you take every year plus and minus, average it together, 5.45%. Average inflation over the same long, almost 50 year time period is 3.9%. If we go forward a little bit in time, over the last 40 years, the average home price inflation has been 4.66%. Average total inflation has been 2.7%. Since 1993, 4.7, 2.43. Since 2003, 4.8, 2.42. The difference is what I'm really interested in. So over these different periods, since about 1983, 1993, and 2003, the difference between the average total inflation and home price inflation has been around 2%. In other words, if you invest in real estate, you do beat inflation. Not by too much, but a good significant amount, about 2%. But that's kind of changed a little bit in the last few years. So, in a normal time, 1993 to 2003, we had that typical appreciation difference of about 2.5%. But then in the housing bubble from 2000 to 2006, the difference was about 6.26%. Big difference from the historical trend. And then as we went from 2012 to 2019, we're getting about to normal inflation, normal differential. And then in just the last 3 years, we are back in the kind of outsized appreciation that we saw during the housing bubble, about 5.3% above normal inflation. And so it begs the question, is this going to mean revert in itself? And I think we have to assume that it does, because historically, these prices, or rather the price relative to inflation, does revert to the mean. And so, in addition to our comparison between the case-shiller and the CPI, if we were to revert just to the middle of this range, then I would want to see something around, let's call it zero point 0.8. In other words, zero point 0.8 case-shiller divided by consumer price index would be a fair mean reversion in home prices. Now, I don't know what that means to the exact home prices, and I don't know what that means in the local market. But when this indicator comes back to the mean, it might be a very good time to buy. And these things take time, these things take years. And so it could be quite a while before that actually happens. There's a little bit more analysis that I did on the actual Case-Shiller Index, which I thought was kind of interesting. So, the last recession, small as it was before the 2008 crash, was 1990. And then it ended about 1991. And what I found interesting was from that low in 1991 up to the high price, the consumer price, the Case-Shiller Index pulled back about 50%, almost half of the full 20 some odd years appreciation. No, not 20 years. It was almost 2 decade appreciation. And so when we beat it 12 years later and broke out, we created a new trend in home prices. Now, I like to look for 50% pullbacks in pretty much everything. And I just think it's really cool that that is exactly where the market tended to stop on the pullback. So, another way to look at this recent trend from the bottom in 2012 is a pullback of 50% on the consumer price index would take us on, keep getting confused, a pullback on the Case-Shiller price index would put us to about 226. We're pretty far away from it, but price has started to come down to it. Another analysis that I wanted to look at was what is normal? And in other words, what would be a normal mean reversion on the Case-Shiller price index? Well, I used a regression line on 2012 to about 2019, where the money printer got turned on in 2020. Let me bring that back up. And came up with something that looks a little like this. So if this trend, if this appreciation from 2012 to 2019 had continued without the Fed pumping money into the system, then we, instead of being here at 300 on the Case-Shiller Index, we should be more around the lines of 255. That would be more normal appreciation given all other considerations. So we've basically got two levels where over time we should be able to pull back to either somewhere in this range here of maybe 260 over the next year to 2024, or in a longer term, if we were to have a recession, which I'm not saying that we will, if we were to have a recession, something lasting a few years, decline in home prices, that would bring us back to a full 50% retracement, that might take us out to 2029. So to summarize, here's what I'm going to be looking for. Over the next year, probably into mid 2024, I'm going to be watching the Case-Shiller Home Price Index to see if it can get back to the mean. In other words, all this money printing, all these houses that were bought up on cheap credit that pushed home prices up very, very high. I'm looking for that to come back to what should have been normal. I'm not going to look for a recession just yet. But if we do see some sort of an economic downturn, if something does seem to be a sustained bear market, then the longer term scenario comes into play. And I'll be looking for the Case-Shiller Home Price Index to pull back to something around maybe 220, 230. And that would bring us down to what will be, to me, logical mean reverted levels. And of course, one final note to kind of check myself. And this would again be in the recession type scenario. I'd be looking for perhaps a mean reversion to about zero point 0.8 in the Case-Shiller index compared to the consumer price index. So I'm looking for mean reversion to play out in the housing market. I know a lot of people say that home prices, it's a good investment, always goes up. True. If you're looking to buy a house for your family to live, this shouldn't stop you. But this is my research. This is what I'm going to be looking for my next my next investment purchase, maybe even home, depending if I want to live. Because I think jumping in right now is being very hasty. We're getting a discount, and I'm going to be patient and disciplined. And these are the things that I'm going to be looking for. So I hope that this helps people do their own analysis. I'll probably revisit this in a year and we'll see what has happened and if we need to update this model. Until then, trade and invest wisely.